Let's talk about growth versus value investing, or you could also say growth stocks versus value stocks, or even income stocks. Now, with these two different stocks, there's also two different methods to make money. Investors buy growth stocks because growth stocks have the possibility to grow in value faster than what the average stock market will do on a year to year basis. So, if the average stock market increases by 7 to 11% in a good year, growth stocks can easily double that. So you can see a growth stock that might hit 20, 30, 40, 50% in growth in 1 year. A company or a stock such as Tesla is able to do that. Now, with a value stock, these are companies that are blue chip companies. These are more stable. These companies are more consistent, and they might not be the most exciting companies. They might not have products or services that are exciting to investors, but they do bring a consistency that a lot of investors like, and they pay out a dividend. So a company such as Walmart or even Fastenal. Fastenal is a company that sells screws, it sells construction equipment. This company is not really that interesting when it comes to the product that they sell, but they do generate revenue and profits on a consistent basis, which they also grow, but not as fast as a growth stock would grow it. So the primary way of making money with a growth stock versus a value stock, it's the mindset that you have as an investor. Because if you invest in a growth stock, you only care about the stock growing as fast as it can and then potentially selling it and making a profit. So your mindset is of a capital gains mindset. You want to make money from the capital gains that you will get from the growth stock. With a value stock, you're focusing on the stock giving you a consistent income in the form of a dividend. The value stock can also, of course, jump up in value, but that's not the primary reason why you would buy a value stock. Now, yes, of course, you can still do options trading, you can still do short selling, but those two are the primary ways of making money with a growth stock versus a value stock. So, growth stocks in general don't pay a dividend because any profits that they make, they put back into the business to grow the business as fast as possible. A growth stock can be in pretty much any industry or sector, but you will definitely see growth stocks in the technology sector. And if you think about it, technology, you have to be creative, you have to do a lot of research, you have to beat out the competition. So instead of taking some of that profit and paying it out as a dividend to the investor, you don't want to do that. You want to grow the company as fast as possible because in the tech sector, there's so much competition. So it's best to take the profit that the company generates and put it back into the business. So some of the things that a company can do with the profits that they put back into the business is research and development, coming up more creative ways to promote their products, updating their equipment, expanding into different locations. There's a multitude of things that the company can do by putting the money back into the business. Take, for example, a company like Tesla. So Tesla sells electric cars and is widely popular, of course. But let's say Tesla came out with a new product. They're still in the electronic car business, but the new electronic car can drive on land, sea, and it can also fly. Just coming out with news like this more than likely will hype up investors to buy more shares in the company, which would potentially make the value of the stock go up even more. And since growth investors like to invest in companies that can increase in value faster than the average stock market performance year over year, these investors don't pay that much attention to the PE ratio of a company. The PE ratio standing for the price to earnings ratio. So the price to earnings ratio pretty much telling you how much price are you willing to pay for the earnings of a company. If you're a value investor, this is a metric that you pay attention to. Most value investors will look at PE ratios of 20 or less, but for a growth investor, since they predict that the sales revenue and earnings of a company will keep growing year over year, the PE ratio is not something that they primarily pay attention to. So the PE ratio, the price divided by the earnings per share, the earnings is the same as the net profit of a company. In order to calculate the earnings, all you have to do is look at the net profit of a company and divide it by the common shares outstanding. So let's say a company made $2 million in net profit, but they have only 1 million shares outstanding. The earnings would be $2. 2 million in net profit divided by 1 million in common shares outstanding. So 2 million divided by 1 million is $2 in earnings per share. The price is the price that you see on the stock market per share. So if a company is trading at $40 and the earnings is $2, the PE ratio is 40 divided by 2 is 20. So what are some of the metrics that you need to look at if you want to analyze a growth stock then? How can you tell if a growth stock is one that you want to invest in? There's two specific metrics that you can take a look at. The revenue of a company, it needs to grow year over year faster than what the average stock market return is. And also you can look at the net profit of a company. It's a little bit more tricky because there are a lot of growth stocks that actually have a net loss year over year, but their revenue keeps growing at a high pace. There are some other metrics that you can take a look at. You can take a look at debt, you can take a look at the return on equity, the return on invested capital. But when it comes to a growth stock, just looking at those two, the revenue and the net profit, those are the two main ones that you need to pay attention to. If you take a company like Tesla, and you look at their revenue growth, Tesla has been able to grow 30 to 50% if you look at the last 5 to 10 years. Take another growth company like Amazon, and you can see that Amazon has been able to grow about 25% in the last 5 to 10 years. Think about what the average growth is of the stock market. So if you look at the S&P 500, you'll see anywhere between 7 to 11% growth year over year. Both Amazon and Tesla have shown more than double in growth compared to the average stock market growth year over year. Now, with a value stock or an income stock, they might not see double digits in growth because that's not the focus. The focus is on the consistency. Yes, they will still grow year over year, but the focus is more on the income that they pay in the form as a dividend to their shareholders. Now, if you look at a stock market decline or a stock market dip or even a recession, there's something interesting that you will see between growth and value investing. With a growth stock, of course, you need to think about the mindset of the investor. They want to buy a stock that will go up in value fast and continue to go up year over year. When everything is going well in the stock market, people are more optimistic and they will pay more and they will buy more shares in specific companies. With a stock market decline or crash, people get a lot more pessimistic. If you look at the growth stock, instead of going up, of course, it's going to dip down, it's going to crash. So people might panic and sell their growth stock. Meanwhile, with a value stock, those, of course, yes, they will also dip in value, but because most value stocks still pay out a dividend, so some might cut their dividend or some might cancel their dividend, but there are still a lot of companies that, even in a stock market decline, they pay out a dividend and they even grow their dividend. And those are the companies that I like to invest in. Investors are more than likely to hold on to those investments in value stocks because they still get a payment in the form of a dividend on a quarterly basis. Let's look at technical versus fundamental analysis and how that plays a specific part or a specific role when you look at growth versus value investing. Fundamental analysis is when you look at the financial metrics of a company, how well the company is performing. You look at the sales, revenue, book value, return on invested capital, etc., etc. Technical analysis is when you look at the charts and you try to figure out how that stock is trending on the chart screen. Value investors like to focus on the fundamentals of the company and then buy the company when it's selling at a discount. Meanwhile, growth investors, they don't necessarily focus on fundamental analysis. Some of them do focus on technical analysis because they want to buy the company at a cheap price and then be able to sell it at a higher price for a capital gain. There are also a lot of day traders and swing traders that like to jump in to the stock market and buy growth stocks in order to profit from small changes in the price of the stock. You can still do day trading with value stocks, of course, but the benefit of doing it with growth stocks is because growth stocks have that potential and that possibility to go up and down in value fast. That's why growth stocks are usually preferred with day traders and swing traders or even scalpers. Now, if you're an investor just starting out and you now know about growth versus value, you might be thinking to yourself, okay, which one would be better for my investment portfolio, a growth stock or a value stock? Now, my thing is always, why not both? Because I like to invest in both. I like to invest in value stocks for their consistency in income, but I also like to keep my eye on the growth stocks because those, of course, have the potential to go up in value. So you're not limited to either or. You can have both in your portfolio. You can also take a look at how much risk you can endure when it comes to investing in the stock market. If you're somebody that's more risk averse, value stocks will be more in your lane because those they pay an income on a consistent basis. They're more stable in a stock market decline. Yes, they will dip, but you can still hold on to them compared to the growth stock. Those are more risky stocks that you can invest in because you're investing in the potential growth of that company. But keep in mind that growth stocks are more fun than value stocks in general. So growth stocks produce products or services that are more enticing to investors: electric cars, music, technology, compared to value stocks, which produce products or services that might be a little bit more on the boring side. But there's nothing wrong with being boring and consistent. Now, which one do you prefer, growth stocks or value stocks? Let me know in the comment section. Be sure to subscribe to my channel, like this video, and I'll talk to you in the next one.